I'm Peter Switzer, and we're going to be talking to people who have been investing to make money, to develop careers, to develop themselves. End of the day, when you sacrifice the money and the time that's yours, it's an investment. And I want to know why these successful people have been able to generate a damn decent return. Joining me today is Jordan Eliseo. He used to be a chief economist at ABC Bullion, but nowadays has been kicked upstairs to be general manager of that very successful company. Jordan, thanks for joining us.
My pleasure, Peter. Real honour to be invited on.
Yeah. Yeah, it's great to have you here as well. Being a former academic economist, it's always great to see a fellow traveller kicking goals, golden goals, big time. So, Jordan, let's just take us back in time to probably explain why you ended up being an economist and why you're interested in investing. Because clearly, ABC Bullion is a gold investor's treasure trove.
Yeah, thank you. So I guess my sort of interest in precious metals dates back really almost 25 years, not quite 25 years. Around 2002, 2003 was when I first got into precious metals as an investor. I was still working in traditional asset management, doing my economic studies, you name it, at the time. But I was actually on my way from, I was working in Sydney. I decided to move to London, traveled fairly extensively through Asia on my way there. Saw firsthand how popular gold was in Asia, people buying it. But probably more importantly, that was also really in the immediate aftermath of the tech wreck, the sort of 2001 sort of stock market crash. And so that had been a real eye opener for me because actually, whilst I was in high school, and sorry, I should say while I was in university and then doing graduate studies and the like, I was working in traditional asset management. I actually spent a little bit of time working at a brokerage firm as well. And there was this real hype and excitement around that tech boom. Almost no one sort of saying, "Hey, this thing's going to come crashing to the ground," or at least no one that I had any exposure to. And so that was a real sort of eye opener experience for me. Add in the travel through Asia and then landed in the United Kingdom, and yeah, just found myself really. I consider myself extremely fortunate that my eyes were open to gold through reading a few articles and some really interesting analysis back then, and it made sense to me that gold was undervalued relative to other assets, and I'd consider myself a bit of an amateur history fan as well, and so I guess I, did a bit of reading, and I was like, well, God, this thing's been money for a long time and been an asset for thousands of years, and yeah, I guess that's where the story started in terms of my interest in gold specifically.
Yeah, it's interesting when it comes to what you learn. And I'm sure there's a lot of younger people who are listening to this podcast right now um, who really didn't experience or understand the dot-com crash, but you worked in a brokerage, and of course, I was doing financial commentary. This is the time when companies that were listed on the Australian stock market disappeared. They had no value. They were one day valued very highly, and next day gone. And that doesn't happen very often. Occasional companies do, but en masse, and particularly in the US, there were some companies that were worth a lot of money that were eventually worth absolutely zero. So how far back do you go um, in your life to uh, understand why you became interested in investing?
Yeah, probably even earlier than that in terms of my sort of investments, I suppose, started quite early in life. I grew up on a small farm in Adelaide. We still went to school in the city. It was only 20 or 30 kilometers out of the CBD. That was kind of an extraordinary thing about Adelaide back then. You could, we had 50 acres of property. My parents were both teachers. But it was almost like a hobby farm, for want of a better expression. We had some sheep, some cattle, a few horses, and a couple of dogs running around. And my dad was always very keen to educate both myself and my brother about the importance of a dollar. He had migrated in the aftermath of the Second World War from Italy. My non came out with basically nothing, and very fortunately were able to build something here that myself and my children now all get to enjoy. And anyhow, Dad, because he bought the cows and the sheep and all that, he said to my brother and I, because we had pocket money and a little bit of cash, and he was pretty clear. He's like, "Look, if you leave your money in the bank, you'll earn a little bit of interest, but you won't build wealth by leaving it in the bank." And
Yeah.
he gave my brother and I the opportunity to invest in a couple of the cows. And he told us what they would cost and then what the upkeep would be. And so we did that. And I'd be lying if I said I remember the exact dollars, but I think over the space of 2 or 3 years, we kind of doubled our money, which is a pretty great feeling at any age, but especially when you're 7 or 8 years old. But no, it was. If I think back on it now, it wasn't about the money per se. It was about Dad wanting to teach us the importance of saving, the importance of investing, and that really is the key to wealth creation. And it's definitely something that carried through. Both my brother and I have always been savers and investors, and really owe that to Dad and to Mum as well.
Yeah. So in many ways, that was a there was a sacred cow that has led you on a road to being an investor. Us. How do you evaluate an opportunity when it
That's
comes
a
to
Yeah, it's a great question. I think, look, from two or three angles. I mean, obviously, the space that I work in now, and the space that makes up a decent portion of my own portfolio, being precious metals, is in some way simpler because there are no cash flows and there's no management or balance sheet or anything like that. You can just sort of look at the gold price, and you can compare it to other assets. You can look at the tailwinds that are driving it. You can look at how fast it might have moved in the last 6 months, 12 months to get a sense of where the market is, and what share of your portfolio you might want to make up. When it comes to other assets, equities, for example, and equities are a big portion of my portfolio as well. Uh, it, it's it's a, it's a funny one because it can either be quite complicated or it can either be quite simple. Now, as I've gotten older and had less time as well, I've found this the simpler works better. And what I mean by that is I spend very little time now trying to pick specific stocks and spend much more time going, which segment of the market do I want exposure to, and what's the best vehicle to do that. And in today's day and age, it's pretty rare that you find a developed segment of the market that you can't just get exposure to via an ETF. So, emerging markets, US equities, tech, you name it. You obviously can go and get stock specific and buy them individually if you want to, but there are products that just make it quite simple. So for me, in my portfolio, it's gold, it's some cash, and it's a few ETFs that give you that diversified equity market exposure. I don't have any bonds, but that's nothing against bonds. It's just more I'm in my mid 40s, so I don't really see the need to own them at this point.
yeah, you're a young thrill seeker. You should be pursuing growth.
Not as young as I was or wish I was, but I'm still on the right side of 50, I suppose, for a couple of years longer.
I've known you over the years, and we've always talked about, in a sense, the commodity gold. Now, I want you to be honest here. Do you hold any gold companies? Because I know I asked that question because a great mate of mine is a very good chartist. Many years ago, completely got the gold price right, but he went into the wrong gold company.
Oh, he went into a specific miner, did he? Or
Specifically, and that company had problems. It
sure.
had management issues, had a good name before he went into it, but he always said to me, "From now on, I'm playing the commodity." Are you in any gold mining companies?
Yeah, absolutely. So, yeah, and in many ways, that's legacy is not the right word, but if I go back to 20 years when I was first getting invested in precious metals, full stop, the data was very clear then that gold mining equities, whilst they bring with them a lot more risk and uncertainty, as it sounds like your friend exhibited firsthand, they also offer asymmetric upside if you've picked the right ones, or perhaps spread your chips around so that don't concentrate your risk in one particular stock. So, yeah, I think it might surprise people, because a lot of people think, oh, if you buy gold, you must be really pessimistic, and you don't want to own anything else. If I look at myself, and I look at most of the clients that I engage with directly at ABC, that's not true at all. Most people, again, myself included, we own gold because we see it as being one of the most liquid and simple ways of protecting wealth, of diversifying a portfolio, and contributing to that portfolio growth. But that doesn't mean you only want gold or silver or platinum in your portfolio. You want equities, you want other things, and part of that equity basket can be gold mining equities as well. So absolutely, I own them in my portfolio.
Yeah, when you're investing stocks, I think you were sort of saying that you're an optimist, but when you're investing gold, similarly, why wouldn't you be an optimist? Sure, there can be pessimists who see it as the hedge against something going wrong, but yeah, there's a lot of optimists who believe that the gold price can go higher, and they're being right as a consequence.
Correct.
Actually, I must admit, when it comes to miners, and I love companies like BHP, with no problems with that sort of company. I love buying it when the share price is low. But I've always laughed at Mark Twain's view on a miner. He said, "A mine is no, a miner is a man standing outside a hole who's a inveterate liar."
Yeah, I have heard that one.
It was so sick. And, of course, very unfair. That Mark Twain offer was very unfair. When you look at um, yourself, and this is something a lot of people are good at, but you've been in the game a long time, come from a very good background. How do you personally define and manage your risk?
Yeah, it's a good question. So again, I always try and bring it back to keeping it simple and trying to learn from the mistakes that you make along the way, which is an inevitable part of the process. So I'd say one of the first things try to do is not to overtrade. And if when I look at it, the more I trade, the more I've got to spend in brokerage fees or spreads, the more tax events I'm likely to be creating. So the less I trade, the better, as a general rule. And then try and keep and have asset allocation guidelines, and stock specific guidelines. So if you do own a specific stock and you've invested in it's 5% of your portfolio, if it goes to 10, you probably want to have a look, right? Like, is it still, it might still be a great story, but it might not be a bad idea to do some disciplined profit taking. Again, that's not advice that you should follow in each and every circumstance, because the story for that stock it might even be better at the 10% mark than it was at the 5% mark, if that makes sense. But to me, it's all about acknowledging signposts and having those signposts where you should review a particular investment or a particular asset class, and then making another decision. And that decision, a lot of the time, might be to do nothing, but at least you've made the decision. At least you've considered it. So, at the risk of sounding contradictory, whilst I don't like to trade too much and I don't like to realize tax events through selling unnecessarily, if you get to a point where a certain asset's gone up too much, or it's become too big a part of your portfolio, you might want to do it. Like, I'll give you a side story, because it was only a small part of my portfolio, but it's probably interesting because of the link to gold. Everyone would think, being in the gold business, that I don't like Bitcoin, but that's not true at all. And I've owned Bitcoin in the past, but there was a point in 2021 where it just went absolutely bananas. And I was like, look, I've just got to take a profit here. Like, I can't, like, every disciplined rule of investing says you have to take some money off the table. So I'm going to do it. And it'll probably keep going higher. And in fact, it has gone higher since then, but I think it was still the right call.
Yeah.
Yeah,
Uh, do you run your super through a self-managed super fund?
I do. And I have for many years. Yes.
Yeah. Oh,
Yep.
also. So what are the routines or habits that help you stay informed and grounded. I think you've covered the grounded one, that you obviously have a discipline. When something becomes too big of part of the portfolio from where it started, you at least ask the question, should I persist with it or should I take profit? But what other habits have you um, used to stay informed about your investments?
Yeah, look, I don't know that there's any secret sauce to it. It's trying to and be disciplined about reading and staying on top of what's happening, and that's probably less about the market cycle or the news cycle from one 24-hour period to the other, and it's much more about reading interesting and informative research from various funds management, brokerage, investment houses that are that are publishing research. Could be on any number of topics. Could be on where commodities are sitting right now. Could be on the capex that's going into AI. Could be on profitability within the Mag 7. Or one of the things that I think is really interesting right now is just how strongly the United States has outperformed the rest of the world in terms of equity markets. I'm going to throw one out there. This will probably get me. This will probably get me hate mail in terms of people saying, "Oh, Peter, that guy hasn't got any idea what he's talking about." But one of the things I'll take a bet that I think he's wrong on is, Warren Buffett always talks about how you should never bet against America, and that I'm not saying he's wrong on that, but the 80, 90 years that he's been alive in is a period in which the United States, for example, their equity market has gone from being smaller than the United Kingdom's to now being 50% of the global equity market. Now, my guess would be in the next 50 years, the United States share of global equity markets is going to shrink. And that's not, I'm not saying that's because the US is going to suffer a depression or anything like that. But to me, the bigger growth and better growth will come from emerging markets. And so, when I look around at some of the things to stay informed on, you want to look at the growth that's happening in China, in India, in other parts of the Middle East, in the subcontinent. Like there are enormous growth stories that are transpiring and that are evolving in front of us. And I think that's probably where some pretty good opportunities are going to be in the years to come.
Mm. So, have you exposed yourself to emerging economies?
Yeah, absolutely. So both directly through stocks that are operating there or businesses that are there, but also as well, I think if you look at developed market equities, having a distinct commodity exposure is to me sort of like a proxy emerging markets play as well, right? Because if you think of, well, where's all the demand for iron ore come from? Where does the demand for coal and gas and where will nuclear, or hopefully nuclear might even come in here in the developed world as well. But the commodity story is an emerging market story right now for developed market equities as well. So yeah, I think those are all things that are people should be keeping an eye on. They're things I keep an eye on. I may be wrong, but there's certainly things that I find interesting and worth monitoring.
So, Jordan, how long have you worked for ABC Bullion?
I've been with the group in total about 13 years.
Okay. And you went away for a short time, did you, and came
I
back?
I did indeed.
Now, in that time, y- have you read stuff about people predicting what's going to happen to gold? And you said, oh, that is absolute BS. That person knows nothing about gold. Because I would have presumed that you at least have tried to become as good an expert on gold as you possibly can. And I know I try to do the same with stocks, and doesn't mean I know everything. There's always something I can learn from somebody else. But sometimes I and that's why I got the trouble on Twitter, some time ago when I kept telling people, no, we're not going to go into recession. And they hated that to the people who
Sure.
got stuck into it. What is there a memorable story where someone has said something about goals and you said, that person has no idea, and they proved to be wrong?
Yeah, I mean,
Oh, all right. And you learned something from it.
well, I think I've been definitely thinking of the guys that were right, and articles that and information that really helped me. One I remember reading, and this is going back over 20 years ago. And this gentleman wrote an article on the Dow Gold ratio, and at the time, obviously, this was at the start of the bull market in gold in the year 2000. And this article was basically, it was, if you had a trade of the decade, it would be to sell the Dow and buy gold, because the Dow had been going up forever. Gold had been falling for ages. And I mean, that gentleman absolutely nailed that call. Um, at the same time, I can remember being extremely bearish, people being extremely bearish gold in 2015, which was the end of the kind of cyclical correction. Those ones didn't weren't timed so badly. But at the same time, there were also people in the gold space that were extremely bearish on the stock market in 2011, saying, "Oh, the stock market will keep crashing and only gold will go up." That obviously wasn't. You did, yeah. That obviously wasn't true either. So yeah, I mean, people. I think there are good and bad analysts in every asset class, and I think you said it yourself in terms of Twitter and the like. Um, it almost feels like you need to be extreme in terms in to at least speak to one side of the church, if you know what I mean. Hyper bullish, hyper bearish. You and I both know the truth is somewhere in the middle.
Yeah. My favorite um, revelation of all time was when the GFC was at its worst. Everyone was panicking. The market was down 50%. And Warren Buffett went on TV and lent Goldman Sachs a couple of billion or something like that. And it was the greatest sign. And that's when he actually used,
Yeah,
can't go wrong investing in America. And
yeah,
negativity had got so great, it needed a circuit breaker, and it wasn't going to be George W. Bush or the incoming President Obama, um, who both tried their best, and no one's going to listen to Jamie Dimon because he was there when stuff was going wrong anyway, despite the fact that he put his bank behind America's banking system. The bottom line was someone who had a lot of credibility put his money on the line. I think he got 10% on that money because that was
we did it.
that's a close the great Goldman Sachs had to pay, but it was a terrific turning point. So this leads us to the next question, because obviously when you came to precious metals, you weren't a gold expert, but you could easily be called a gold expert because you've lived and breathed the stuff for a long time, and you might then have self doubt about that, but I don't be sure. What is the best book or the best gold thinker that you've read that's deeply influenced your understanding of investing in gold?
Yeah, that's a very tough question in terms of just picking out one. Actually, I would say that the people that have most impressed me about gold in terms of the way that they have spoken about it, analyzed it, actually haven't been let's call them gold centric people. It's been people from more mainstream finance. And in fact, even Buffett, and to maybe flesh out my comments from before, I mean, people should listen to absolutely everything that guy says for obvious reasons. And in fact, even his views on gold. And he's quite right when he says it's not income producing, it's not a productive asset like stocks are, you name it. But he's also very clear that dollars are designed to lose value, and so you need to put money into other things. There's another gentleman that called Grant Williams who wrote or who published for many years, um, not just on gold but on a variety of financial topics, who I've found to be very much worth paying attention to. And the gentleman that wrote the sell gold, sell the Dow, buy gold was a gentleman by the name of Bill Bonner. So I traditionally read what he had to say, and he wasn't always, his trades of the decade haven't always been gold centric. He got very bullish on Japanese equities, I remember, and then they went and had a tear. So yeah, I've found the best people that talk about gold aren't just, they're not in the weeds of gold. They're financial system analysts who recognize what gold is, if that makes sense.
Yeah, yeah, totally.
Yeah.
What belief you hold about investing that most you think would disagree with?
Oh, a belief I hold about investing that most would disagree with. Um,
You say nothing if you want to.
yeah, I think it's a difficult one. I mean, I think most people probably there are things that I think are true that I suspect most people probably would like. It's sensible to diversify your wealth if you want steady but not spectacular growth. if you do want your wealth to really magnify, you've got to occasionally swing for the fences. Um, may, Maybe the one that I'd say is the most, well, at least it wouldn't be consensus thinking amongst traditional asset allocators. And that would be my one would be that at least if we take the next 10 years looking forward, I think the idea that defensive asset exposure should come through fixed income securities, I'm not sure about that. In a world where rates are low and inflation is still problematic, and we had a 40-year bull market in bonds, I I'm not convinced that they will provide the kind of defensive qualities in the next decade that they did in the previous 40. Maybe that would be my
Yeah, that makes
observation.
very, very cool. I really wish deposits were always 5%, so I don't have to go looking for other defensive assets for my financial planning clients that I don't have as much confidence in. So yeah, I understand bonds can be difficult to play, not straightforward. What mindset shift would you recommend to someone wanting to get better at investing?
I think the key one would be an acknowledgement that it is not easy to meaningfully outperform the market and reliably outperform the market. That wealth does take a long time to build, unless lottery ticket, obviously with an individual stock or an individual crypto or whatever. But as a general rule, there's a reason why the majority of wealthy people, and again, Buffett's a great example. If you look at his wealth, something like 99% of his wealth was built after the age of 50, and that's because there was 30 years of foundation that was laid. And then from there, it started to grow very, very significantly. And I think there is no cheating those rules of investing without taking the kinds of risks that can end up blowing your portfolio up. So I think that's just a reality that people should acknowledge.
Okay, one last one before you go, and that is if this bull run on the stock market should eventually end up in a crash for whatever reason, overestimation of AI creates unemployment bigger than we expected, that sort of stuff. If the stock market crashes, what happens to gold prices?
I suspect if history is any guide, Peter, that gold would do very well, uh, especially on a relative basis. So, in a world where the stock market drops 50%, if the gold price just stays static, well, gold now buys you twice as many stocks as it used to. So I think in the extreme short term, gold might even come off a little bit because it's so liquid that people can use it to fund margin calls and the like.
See cash. If you went dollars, yeah.
Correct. But I think, if you, as that sort of, let's call it, crash cycle plays out, I think gold would do pretty well in nominal terms, and it would do exceptionally well in relative terms. And indeed, if something like that were to happen, and you know, in my own portfolio, and gold became an even bigger share because my equities fell in value, and so therefore by definition my gold's gone up, I'd certainly be looking at that going, well, great, I can buy some more income producing assets with this bullion that's held or in relative terms even increased in value.
Yeah. Yeah, just as you say that, it's interesting because probably during that period after the GFC, and that was March 2009, that's when the stock market started to roll back, and probably people who were safe in gold started taking their profits in gold to buy stocks that were smashed and crashed and had an enormous rebound. I must look into that. I've never looked into that as a topic, but a very interesting one to have a look at.
Absolutely.
Great stuff. Jordan, thanks for joining us.
My pleasure, Peter. Really enjoyed the chat.
Me too. Jordan Eliseo, General Manager, ABC Bullion.